Hey everybody, this is going to be a short video to talk a little bit about how the BSG performance is evaluated. So basically how your company's performance in the BSG is going to translate to a grade for you in the class according to the syllabus. Okay, so um, first thing, the grading is based on something that's called the game to date best in industry ranking. Okay, so there's a couple of pieces there. I'll break it down. Best in industry ranking. So when you're in the BSG system, when you're looking at the reports, the scoreboard, you're going to see a lot of different performance indicators. So, for example, you'll see something about investor expectations. You'll see something about bonus points for having great forecasting or improving performance year over year, and things like that. Okay. As far as I'm concerned, none of those things matter. The only thing that matters is the best in industry ranking. Okay. Um, that's based on five things. It's based on your company's earnings per share, return on equity, image rating, credit rating, and stock price. And since it's a best in industry ranking, it's based on how your performance in those five metrics compares to the other companies in the industry. Because you go all the way back to the foundations, that's really what we've been talking about from the beginning is how do you perform relative to the competition? Okay? You want to win, which means you want to beat them, and you want to beat them in terms of those five metrics. Okay, so the best in industry ranking. Okay, um, and I'll show you in a second. I'll show you some specific graphs of how that translates into a grade. Okay. The other piece of the criteria is the game to date. Okay, because you will get a best in industry score each year that you're running the company. Right. But strategy is a long-term phenomenon. It's not uh, what matters this year isn't what matters. What matters is what happens over the long term. Okay, so I'm going to leave it up to you to look in the player's guide and see specifically how the game to date best in industry ranking is calculated. Okay, just know at this point that it's based on those five metrics that I just mentioned, and I'll show you here in just a second how it translates into your grade. Okay, so let me pull up some slides and we'll take a look at it. Okay, so like I said, the grading is going to be based on the game to date best in industry ranking, and I'm going to show you how that works based on an actual set of data from a previous semester. Okay, so this was some years ago. This was the game to date best in industry ranking for the companies in this particular industry over the first 5 years that they were running the companies. Okay, um, so what you're going to see is obviously there's variance in that performance, right? The company that called themselves the Future Billionaires had the highest score for the first 5 years. The team that called themselves the Cucking Flogs had the worst score at the end. Okay, they didn't start there, but that's where they ended up after year 15. Okay, those endpoints are going to define the the endpoints of the grading scale for the base grade. Okay, and there's two components. There's the base grade, and then there's a modifier that we'll talk about in a second. Um, but if you look at the actual game to date best in industry score, the best in this industry after year 15, the future billionaires had a score of 98. Okay, the score is going to range between 0 and 100. The Cucking Flogs had a score of 33. Okay, in my grading scale for the base grade, that translates into a 100% for the team that does the best in terms of the game to date best in industry, and a 70% for the team that does the worst. Okay, and again, that's the base grade. There are going to be modifiers we'll talk about in a second. Right? Now, for everybody else, what matters is where you fall in between first and last. And when I say that, I don't mean second place, third place, fourth place. I mean literally in terms of that distribution, how close are you to 98 and how far away are you from 33? Okay, so if you think 98 is the best score, 33 is the worst score, 98 translates to 100%, 33 translates to 70%. What that tells you is a score that's exactly halfway in between those. So if you had a game to date best in industry score of 65.5, halfway between 98 and 33, you're going to have a grade which is halfway between 100 and 70. So your grade would be 85%. Okay, so in this case, the company that called themselves Deathmatch, they would have gotten a grade after year 15, which was just slightly over 85%, right? Because it's graphical here in the image. Okay. Um, the reason I do it that way, the reason there's not a defined grade for second place or third place or fourth place, it's pretty easy to imagine a scenario where a team is in second place, but first place is so far ahead that second place is never going to get into first place. And third place is so far behind that second place doesn't have to worry about being overtaken by third, right? If the grade was based on being in second place, at that point, that team has no more motivation to do anything else, right? There's no incentive for them to keep trying. The way I do the grading, if that second place team, even though they know they can never catch first, if they can at least get closer to first, and on the flip side, farther away from last place, they're going to improve their grade. Okay, so there's always an incentive for every team to try to do better all the way to the very end. Okay, and I'll show you an illustration. This industry that I'm showing you here didn't end after year 15, right? They actually ran the company for a full 8 years. So if you look at, well, this is after round 15. If I had done the grading then, this is what the breakdown would have been. The future billionaires would have gotten the base grade of 100. The cucking flogs would have gotten a 70. I said before that the team, the death match, would have gotten something just slightly over 85. What you see here is they got an 86.1. Okay, so that's how the distribution works. If you look at what happened in this particular industry as time went on, this is what the distribution looked like at the end of the 18th, the 8th year that they were running, which is year 18, right? Now, the best company in the industry had a best in industry game to date score of 86. That's still 100%. Even though their game to date best in industry score came down, they're still beating everybody. They still have the highest in the industry, so they still get the full 100%. They get the best grade. Now it's no longer the cucking flogs in last place. Now it's Iglesias Enrique with a score of 54, game to date best in industry. That gives them the 70%. Okay. What I want you to look at though specifically on this is the Hungry Hippos, which is the pink line. Okay, they're in second place here after year 15. But look at the gap between them and first place. They're closer to the middle than they are to first, right? Now, if you fast forward to after year 18, the Hippos are still in second place, but look how close they are to first, right? If you look at the team, I'll come back to that in a second, okay? So what that means is, since they're closer to first, even though they're still in second place, their grade will be better, okay? And I'll show you that here. If the game had ended after round 15, the Hungry Hippos in second place would have gotten an 89% because they were closer to the middle of the distribution than they were the top. After round 18, they were very, very close to first place, and so their grade is very close to 100%. Okay. Something else I want to point out here is deathmatch. Okay, if you come back to what it looked like after year 18, you'll notice that on the graph, the Hippos and the deathmatch have exactly the same game to date best in industry score. Okay, what that means is they're going to have exactly the same grade, right? So at the end, after year 18, they both would have gotten the 97.3%. Okay, so the team, the Cucking Flogs, which was in last place, they would have gotten the 70% base grade. They don't anymore because they've gotten better. They've moved up in the distribution, so now they're getting an 80%. Now it's Iglesias Enrique that's the worst team, the worst company in this industry with respect to the game to date best in industry ranking, so they get the 70% base grade. Okay, so that's how that's determined. There's actually a document on Blackboard under course information if you want to see all this again. Okay, if you want to see it written out. All right, but that's just the base grade. There's a grade modifier. So if you think about what your role is in these organizations, these are publicly traded companies. And go back to the foundations, your job is to do what's best for the owners, what's in the long-term best interest of the owners, which in a publicly traded company, that means generating long-term abnormal returns. One way that shareholders get returns from their ownership of your company is through stock price appreciation, right? So if you're doing a good job, you're doing what you're supposed to do, you should see the stock price going up over time, okay? When you take over the company, it's already been running for 10 years. It's already being traded at $30 a share, all right? So here's the thing. If you run the company for 8 years and you actually destroy shareholder value, meaning the stock price when you're done is lower than it was when you took over, there's a 10% penalty on top of whatever your base grade was, right? So if your base grade was let's say, worst case scenario, you have the lowest game to date best in industry score, which gives you a base grade of 70, and your stock price is below $30, your grade will be a 60%, the 70 minus the 10, okay? You don't have to be the worst in the industry to get this penalty, right? So you could have a base grade of 75 or 80% because you weren't the worst in the industry, but your stock price is still below $30 a share, you're going to get the penalty. Okay, so just keep that in mind. That nobody has to get the penalty. There's nothing forced about it. That's just a consequence of not being effective in the way you've run the organization. Okay, so that's the basics on how I grade. I'm going to show you a couple of other sort of historic graphs, and I'm going to back up just a second because every industry develops differently over time. Okay, because this industry is unique. This industry is the sum total of the decisions that you all are making. It's never happened before, right? But I will say there are certain patterns that I see, right? This semester, the team that started off on top dominated throughout the entire 8 years that they were running the company. Until the very end, they started to get caught by the competition, but they started in first place, they ended in first place. This is really, really unusual. Okay. What's more typical is a pattern something like this. Okay, you notice the crapshoot that eventually dominated started off after the first year. Their best in industry game to date score was the lowest. Okay, and the reason I point that out is, and I'll show you another example in a minute. Think about what it takes to look good this year, right? Go back to those foundations. Um, our objective is to generate long-term returns, not short-term returns. If I do the kinds of things that I need to do to make my numbers look as good as they can this quarter or this year, there's a pretty good chance that I'm not making smart investments, right? I'm not building resources that are going to allow me to be successful over the long term, right? Um, and I'll take an example from my personal experience. Research and development this year is nothing but a cost. You don't see the benefits of that research and development until 5 years from now, right? So if I'm thinking, how do I make my numbers look as good as I can right now? I'm going to eliminate R&D. I'm not going to do any of it because all it does is increase my costs, right? That's going to help my bottom line right now this year, right? But next year, the year after that, I'm going to be at a significant disadvantage because all of my competitors will have been innovating in product or process. They would have had better features or more efficient operations or all kinds of things, the benefits that you get eventually from effective investment in R&D. Okay, so in a situation like that where a company is thinking about the short term, they're going to tend to do very well in the short term, but over the long term, they're going to get their butts kicked by the company that had a plan, was making smart investments. Okay, so this kind of pattern is very common, right? The teams that eventually go on to win don't start off high in the rankings right at the very beginning. Okay, so I'll come back to this in a second too, but uh, I say that to say this: when you're making your decisions and you're looking at the outcomes, don't freak out if after the first year you're low in the rankings, right? At that point, the question you need to be asking yourself is, are we making good decisions? Are we making smart investments? Are we achieving the strategic position that we're aiming for in terms of being a cost leader or differentiator or a focused version of one of those? Because if we are, if you're making those good decisions, you're going to see the benefits of it as time goes on. Okay, so something to think about. Here's another, sort of an example of the same kind of pattern. The flamethrowers started off exceptionally well. I mean, they were ahead in the first year by a pretty good margin, and they went on to end up next to last. Okay, how does that happen? Well, they were probably making decisions that made their numbers look as good as they could be in year 11. Right? It's not the same as developing an effective strategy which will allow you to be successful over the long term. Okay. Um, Now, something else that comes up a lot. What's the best strategy? Is it better to make 4-star shoes or 10-star shoes? Is it better to be a low cost leader? Is it better to be a differentiator? And the simple answer is there's no such thing. There's no best answer. This isn't you against an algorithm where if you figure out the right inputs, it's going to win every time. This is you against other people who also want to win. Okay. There's nothing inherently better or worse about any of the strategies. What matters is, do you have a strategy and are you implementing it effectively? Okay. And this is, I put this up to give you an example of that. Two teams tied for first place. So two teams got the 100% base grade this semester. One of them was making 10-star shoes. One of them was making 4-star shoes, right? Totally different strategic approaches. One was obviously trying to be a cost leader. One was obviously trying to be a differentiator, and they both did exceptionally well. Okay, so there's no one strategy that's better than the other. Um, Something else I want to point out: if you look at this chart here, right? So two companies, one made 4-star shoes, one made 8-star shoes. One sold their shoes for only $42. The other sold their shoes for $55. Now look at the volume. Look at how big company E was, right? They sold 11,500 pairs, actually millions, because most of the numbers in this simulation are in thousands, right? So they sold 11.5 million pairs of shoes. Goon Squad sold less than 4 million pairs, right? Look at gross revenue. E had more than twice as much gross revenue as Goon Squad did, right? But here's the thing, look at profit. Goon Squad was actually more profitable, okay? And if you look at the outcomes at the end of the semester, E and Goon Squad tied for first place, okay? So when you're trying to decide about your strategies, about your approach, about your implementation, I show you this chart to drive home something that I've talked about right from the very beginning in the foundations, which is it's not about growth. It's not about market share. That does not define your strategic success, right? If it did, if market share is what mattered, E should have walked away from this because they literally had almost 3 times as much market share as the Goon Squad did, right? 11.5 million pairs versus less than 4 million pairs, okay? If you think that what matters is market share and the number of pairs that you're selling, you're probably going to lose because I'm not saying that doesn't matter, but it's not what counts. It's not what ultimately matters most, right? There are more than one way to skin a cat. You can get to the profit, you can get to the returns in different ways. Okay, so obviously E took the path of volume over margin. Goon Squad took the path of margin over volume, and they both ended up in the same place. They both ended up winning. Okay, so just keep that in mind. There's no one right answer. There is no one best strategy, and you have to always keep your eye on the prize. And the prize is not market share or volume or revenue. It's profits and returns. Okay, it's earnings per share. It's the return on equity. It's the stock price. Okay. Um, I put this up here. This is a graph again from a specific previous semester. Um, I put this one up because I want to talk for a second about how to win the BSG. Okay, and I use those terms specifically because if you go to Google and you type in how to win the BSG, you will get multiple hits. There are websites out there that will tell you specifically how to win this thing. Okay, and you are more than welcome to use them, right? But there's a couple of caveats that I want you to keep in mind. Number one, go back to the chapter on internal analysis, the resource-based view. What might give you a sustainable advantage over your competition, right? Um, Something that's available to everyone isn't going to be a source of advantage, right? It's like, uh, will the Cubs have an advantage over their competitors this summer because the Cubs are going to wear shoes? No, right? Shoes are good, shoes are valuable, but it doesn't give them an advantage because everybody they play against is going to wear shoes too, right? Um, can you access and use these how to win the BSG guides? Absolutely. But guess what? So can everybody else. Okay. And I'm going to come back to that in a second. Right. The second reason, the second caveat to think about with those how to win is the fact that this industry is different than theirs. Right. The people who wrote those guides aren't competing in the same context, didn't compete in the same context that you're competing in. Right. You have different competitors who are making different decisions, which are causing the industry to develop and evolve in ways that are unique to this particular class, this particular section. Um, and again, we've talked about from the beginning how good decisions are always contextual. There's no such thing as a right decision or a wrong decision. It's a question of, is this decision right in the context in which I'm operating, right? So your context is different than theirs. I would be a little naive to think that their solutions will work for you, okay? Um, this idea that the guides are available to everybody, that's this picture right here is an illustration of the effect that can have, okay? And I get specifically, I'll give you an example. One of the things that a lot of those how to win guides tell you to do is immediately when you take over the company, borrow tons and tons of money and build tons of capacity, right? Because everybody knows bigger's better, economies of scale, all that nonsense buzzword crap we talked about from the beginning, right? Um, so clearly that's flawed even from an individual perspective. From an individual company's perspective, you would be foolish to build capacity that you don't need, right? The demand for your product should drive the size of your operations. Okay, so that's right there. That should throw up a red flag when they say build capacity, right? You should ask yourself, do I need it or not? Or is it just an additional cost that I'm going to incur to build a facility that's just going to sit there idle, right? Because nobody wants my shoes, or not enough people want my shoes. That's one thing. Um, this is what happens when, as an industry, all the companies read that guidance and follow it. Okay, so what I want you to look at is capacity divided by projected demand, which is this blue line. Okay, this is basically giving you a sense for how much excess supply is there in the industry. Okay, so there's a certain number of people in the world who want to buy shoes. We as an industry, all of us, each of our companies builds more and more capacity, bigger and bigger factories, to the point where we could make almost 60% more shoes than what anybody in the world is going to want to buy, right? Think about the impact that has on the supply and demand, the economic impact of that. And you can see it right here. As that's happening, as the industry is building more and more capacity above what they need to satisfy demand, net profit is falling and falling and falling and falling to the point where right here, the average profit across the entire industry was zero. Okay. The industry as a whole made no money. Sold tons of shoes, but made no profit because costs were so far out of control because of this capacity issue. Okay. This was a direct result of doing exactly what those how to win guides told them to do. Okay. I pointed this out at about year 14. I pointed out to everybody in the class that they had a serious problem with overcapacity, that they had built factories that they didn't need, and they started selling them off, right? To the point where at the end, there was actually a shortage of capacity, right? They couldn't make enough shoes to sell to everybody in the world who wanted one, right? Well, think about the effect that has on pricing pressures and everything else, right? And you can see the effect right here. As they brought their capacity down to a more rational level that matched what people wanted, net profit goes up and up and up and up and up. Okay, so those guides are out there. You're more than willing to use them, or more than welcome, I should say, to use them. But just be warned that they're not going to work like you think they will. Okay, because this industry is different, because everybody has access to them. Okay, all those things. I'm getting close to the end here. This is a chart that I show you basically in anticipation of the presentations you're going to have to do at the end. Okay, you look at the assignment for the presentation, and hopefully you will soon. What I'm asking you to do is to analyze what happened, explain what happened, not summarize, not repeat. Okay, and there's a huge difference there, right? What I don't want in these presentations, and I'll post a separate video about this for nobody to watch. What I don't want is you to tell me, okay, in year 11, we decided to make 8-star shoes, and then we built capacity in Europe, and then we lowered our price to $32, and then in year 17, we decided to exit the Latin American market, right? Everything I'm saying to you is information that's available in the reports. There's no value added. It's just a recounting, a summary of what was done. Okay. What I want is an explanation of how those decisions led to the outcomes you got, right? Or maybe how decisions that other people made led to the outcomes that you got. Okay. So if you win this thing, if you lose this thing, you need to understand why. All right. So as you're going along making the decisions, and you need to understand that not just from the perspective of giving a good presentation at the end, but you need to understand cause and effect every year so that you can make better decisions every year, right? If you don't know what's really driving your performance, whether it's good or bad, then you're not going to be able to respond effectively. You're not going to be able to make good decisions, right? You might think that you did well because of great decisions that you made, when in reality, you got a lucky break based on something that somebody else did. Okay. And if you don't understand that, then you're not going to have long term success. Okay. So that's why I show you this chart. This was a specific industry. And again, this is an industry wide chart. So it may or may not be relevant to a particular company that was in this industry. But here's a chart that shows the exchange rate impact overall, right, in the pink, and the industry average stock price in the green. All right. This is pretty suggestive to me, right? Correlation does not guarantee causation, but you can make a pretty good story here that says our performance in this industry was driven largely by stock price, or sorry, the exchange rate fluctuations. That had a huge impact on our performance as an industry. Okay. In some cases, it might be something like forecasting error, right? So you as a company, maybe your forecasting is just way bad, and that's causing your costs to be unreasonably high, which is causing your earnings to be unreasonably low, which is causing you to do poorly. Okay, it's not enough to say we did poorly. And actually, it's not even enough to say that we did poorly because of exchange rates or because of forecasting errors, right? You have to be able to show evidence that that's really the case. Okay, and I'll get to that in a later venue. Okay, but this is something. This is the kind of thing I'm talking about. This chart right here. When I say I want you to explain, when I want you to show evidence, when I want you to analyze, this is the kind of thing that I'm talking about. This is the kind of thing I'm going to be looking for. Okay. We're back to the beginning here, so that means I'm done. If you have any questions about any of this, don't hesitate to let me know, and I wish you all the best of luck.